I think structure is just as important as strategy, if not more important sometimes, because you can give me a deal which is mediocre, but if I can structure it any way I want to, I can make it an amazing deal. And you could give someone a deal that's amazing, but if it's not structured right, then it can be really bad for them. You can make one party get all the collateral, all the income, all the profits first. You can have one party triple their money before the other party makes any money. There's many different ways to make a deal, good or bad, via structure.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 370. My guest today is a true thought leader when it comes to raising capital from high net worth and ultra high net worth investors. His book, Capital Raising, is the best book that I've ever listened to on the subject, and his material on pitch decks is an absolute game changer. Richard C. Wilson was last on the show in 2019, episode 184, and I'd highly recommend listening again to that conversation. Since then, Richard has purchased the domain for billionaires.com, where he's interviewing 100 billionaires. He's also added a shark from Shark Tank to his team, closed on over 500 million in deals, started over 200 family offices, and hosted 185 live events through familyoffices.com. Richard, it's great to have you back on the show.
Yeah, appreciate you having me here, Brian.
I really do think that you're head and shoulders above a lot of the other people out there who are talking about fundraising. But tell our audience, for those who don't know who you are, like what you're all about.
One unique thing that we're all about is we're always encouraging people to invest in their health, because if you don't have that, the rest of your investments go to zero. We also are all about integration or integrity of different parts of your life, whether you're a private investor listening to this or somebody trying to raise more capital. If you have the wrong team members or not the right values, or you live in the wrong place, or anything from the food you eat to where your office is located, all those things can slow you down if they're not integrated into where you're really trying to grow, and they just create friction. So those are some things that are unique, but just a little bit more background. I started our investor club 16 years ago. We have 4,000 investors in the club. We've hosted 190 plus live events. I've written 13 books. We have 2 million followers on social media. We've bought some big media platforms. So we do a lot in buying or investing into profitable medical practices. And then we do a lot in the short-term rental property management space. We have 84 short-term rental properties in our investorresidences.com short-term rental property fund. And on the medical practice side, we have equity now in 23 medical practices that do about 45 million a year in revenue. So those are the two areas we focus in. And then we're just really helping people start their family office and listening to what they're up to and trying to be helpful to them through our club.
What are you specialized in? Like, what are you really good at? What is your secret sauce?
We do have a 25-person team, and running an investor club, we see 1,000 deals a month, and we spend $4 million a year in overhead running the club. So we just see a ton of deal flow. So it really helps me to ignore 99% of it and only pay attention to the short-term rental stuff and the medical practices. And I just keep my clients in mind. And so my skill set is really in positioning and scaling up a business through systematizing, using data and marketing processes to grow something. And we're really good at structuring, negotiating, and sourcing deals. And so we happen to apply the business positioning and marketing expertise to the family office industry for 16 years. And the byproduct of being really good at marketing our investor club leads to a lot of deal flow, 1,000 speakers plus on stage at our events over time. And we pick up all of these different investment structures and strategies each time we host an event. And so we're collecting these as we go. And like in Poor Charlie's Almanac, which is Warren Buffett's right-hand man, Charles Munger wrote that book. He talks about how you need to collect 100 mental models over your lifetime to be good in business. And what we're doing is just collecting mental models on how to put together a family office, how to structure a deal, how to originate off-market deal flow, et cetera. And then we're always just putting those models to work for our clients and in these areas. But it's more simple than it sounds. I know there's a lot going on, but it simplified things massively when you decided to focus on those two areas.
I know you as a thought leader in raising capital, family offices, but you just mentioned two things that are kind of seemingly peripheral to that. One is short-term rental fund that you have and the medical office investments. Why those two things? Why have you gravitated toward those in what you primarily spend your time on?
The ultimate leverage of me knowing a lot about structuring deals, sourcing them, and raising capital is to actually build a platform ourselves versus, if we knew what we were doing and putting a lot of deals together, but we never actually did it and we just taught other people, you question whether that person really knows what they're doing. It's like, why wouldn't they go build a massive empire then at the same time if they really knew what they were doing, right? So we decided that's what we should be doing at the same time. And so the more successful we get on those two platforms, the more value we give the members of our investor club based on how we structure those deals, how we closed an investor this morning, how we worked with a new family office yesterday. And we share those in our workshops and on stage at our conferences. So that's partially how it's connected. And then the other thing is that we chose those two niches for two very different reasons, but they're both unlikely to completely lose our investors' money. They're both cash flowing businesses. They both can be scaled up and sold in a portfolio. And with the Airbnb short-term rental properties, less than 1% of short-term rental properties are owned by institutions. Institutions own just under 3% of SFR, single family residential, but they own 25% of multifamily. And so we think if we build up a portfolio of 500 short-term rentals, that the institutions will come knocking in 5 or 10 years, and they'll want to own more than 1%. On the medical side, we know that when you gather together 12, 15 different medical practices that are all profitable, you can sell them at 12 times, sometimes 15 times EBITDA, very nice valuation. But we also know that when a doctor goes to school for a decade and then they get a residency, then they get a job, and then they start a practice and start a second location, they've put 17 years of their life into that medical career. They're very unlikely to run away with my investors' money to Venezuela or just say, oh, this idea didn't work. Sorry, we lost your money. Very dedicated. They're very committed to their craft. Banks love to lend to these people because they very rarely go under after they've grown to 7 figures per location. So very, very different reasons of why we chose those two niches, but we wanted one in the operating business niche area and one in the real estate space that weren't overly crowded.
You talk about deal structure and how important that is. And I know you see a lot of deal structures. You've employed a lot of different ones yourself. Talk about that. Why is deal structure so important? And if you can give us some examples of how you're doing it with both of those different types of investments, that would be great.
I think structure is just as important as strategy, if not more important sometimes, because you can give me a deal which is mediocre, but if I can structure it any way I want to, I can make it an amazing deal. And you could give someone a deal that's amazing, but if it's not structured right, then it can be really bad for them. You can make one party get all the collateral, all the income, all the profits first. You could have one party triple their money before the other party makes any money. There's many different ways to make a deal, good or bad, via structure. And so with the short-term rental property fund, what we asked ourselves is, over 16 years running our club, what does nobody offer, but we think every investor would appreciate? And what we designed is a structure where we make enough money off our core business. We don't need to make money off of our investors until they've gotten all their money back and they've doubled their money. And so we structured it so there are no fees up front. There's no annual fees. And you are capped at a 2x return, but you double your money before we make $1. That way, you know that we're really gunning to double your money. And the faster we do it, the better it is for everybody. Those big investors who come in for $400,000 or $1 million plus, which we've had several of, they get some co-investment rights to get some extra equity in some deals. But we're essentially doubling someone's money before we charge them even $1, which is, in my mind, the future of how investment management will be. Is more about, hey, we make money after we've made you money and not charged you 19 fees along the way. So that's one way we use structure. On the medical practice side, what we're often doing is going to the owner of a medical practice group, which is profitable and growing. And they typically see two options. They can get bank financing, which is always the cheapest money, or they can sell their soul to private equity and have a job for 3 years and work off their earnings period there. We give them another option to delay selling to private equity, and we help them grow. And we have a proprietary structure we've designed that helps the investor double their money, get an equity kicker on further upside, but not dilute the owner of that medical practice very much. And then that way, the medical practice owner likes us. We usually join their board or invest some of our money in their medical practice, and we help them grow without getting overly diluted. This is basically the short version of how that works.
And both of those structures, how did you arrive at those? Was there some trial and error? I mean, was it driven by what you thought would work best or what your investors were telling you they wanted to see?
A lot of trial and error. And then I've been to every one of our 190 live events. And like our last event had 135 speakers on stage and 1,400 people in the room. And there was a private investor dinner and a private yacht cruise. And so you times that, not every event is that big. That's our annual one, but you times that times 100. And there's just a lot of feedback that builds up over time in your head of most investors want this and most don't like this other thing. Like most investors want transparency. Most investors want performance-based fees and not huge upfront fees before you've done anything for them, et cetera. They also like simple models that are easy to understand, and they want to know that you have some skin in the game. And so it's really a collection of just listening to them over a period of time and then trying out the model, evolving the model, trying it out again. So we've done 13 deals where we've structured it as a gross revenue royalty investment structure, for example. And every time we do a deal in that type, the deal gets better and smarter, and we tweak the structure a little bit. And so the more we can help our clients with these structures, the more we use them, the more that we develop these not only mental models, but legal structures that help with bringing the capital in swiftly when we need to, but also just aligning everybody so everybody feels good about the risk in the cash flow in the deal. When
you look at what investors are looking for, you kind of mentioned some of the things that they're looking for, but what is most important? Are they looking for an IRR? You mentioned transparency. Obviously, that's important. Cash on cash return. I think you mentioned a gross revenue, a share agreement of some sort. Like what is really important to investors? And then what do we think is important, but really isn't?
What's most important is that they trust the team. So if your structure leads to more trust, then that definitely helps. I think most investors I talk to, they'd rather invest with someone who's promising a 15% a year return, but they actually believe them and think they're an honest, really great team to work with, instead of somebody promising 25% a year returns, but they seem a little bit shady or not aligned. They'd rather go with the more sure thing of someone who's going to treat them well. But in terms of structure specifically, I think what's most important is that people get their initial investment off the table, and now it's just gains they're riding on. And then their blood pressure goes down a little bit. And they say, okay, everything else from here is a gain. Structuring things that are tax efficient is important to most investors. And I think they don't mind the person running the deal doing very well and getting paid handsomely, as long as you're both winning at the same time and you're not getting a whole bunch of fees up front just for tying up their money. And the thing is, if you go to an attorney, what do you think they're going to say if you want to put together a fund or a structure? Oh, let's sit down, listen to your exact customer niche, your exact model, and let's custom design a legal structure that nobody else has in the industry and I've never done before. And let's take a whole bunch of time to draft a whole bunch of new legal language. They're probably not going to want to do that. They probably charge, $12,000, $15,000, $35,000, $70,000 to put together a fund or a structure. And they would rather you use a template they've used 92 times before. No offense to lawyers out there. Like one of my friends, Joel, says there's really nothing wrong with lawyers. It's just the 99 out of 100 that give them a bad name. But basically, the lawyers would rather do something the same way their other 99 clients have done. And they'll say, oh, this is how everybody does it. This is the best practice. Okay, well, then you have no advantage over all the other people pitching your investors' deals because your deal is structured like everyone else on planet Earth with a 7% pref and a 25% profit split on the back end and a 1 or 2% acquisition or management fee. So that's okay. I mean, you could have a boring brand like Wilson Capital and a boring structure. If everything else is amazing, then you could still bring in investors. But why not have your brand sweat for you and call it San Diego Self-Storage Partners if you're only buying self-storage in San Diego? And why not have your structure sweat for you and have it stand out from everybody else? But lawyers don't encourage this because that usually means a lot more work for them.
You mentioned tax advantages like a tax structure and how that can incentivize an investor as well. But yet that's one of the things that those of us who raise money don't really think about as much as all the other components of raising money. What are some of the tax advantages or tax structures that you look to employ that incentivize your investors?
Sometimes a company might need or a piece of real estate might need a certain amount of equipment. And if you have a separate LLC or a separate business that just buys the equipment, you might be able to 100% bonus depreciate that equipment and then have that leased from the real estate company or the company that's raising the capital. And then maybe the investors get a good return and the deal is not done just to find a creative way to save the money on taxes, but it's done in a way that's tax efficient. So that could be one example. Another way is you could have 2 or 3 sleeves of investors. You could have a sleeve of debt investors that make a 10% return per year or 12% a year return. And because they're not equity holders, anyone who does invest on the equity side would get more potentially bonus depreciation in a deal. You have to see what type of traditional debt you're putting on that deal and if all that makes sense and can be done. But I've seen some people structure deals in that manner as well, where there's different share classes, and one type is a preferred return or a debt investor, another type is an equity investor, and then that boosts the tax benefits to those who do hold the equity. So that'd be a couple examples of how to structure something to be tax efficient.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbAssociatesLLC.com.
You recently bought billionaires.com. And I know you've been interviewing billionaires. Your goal is to interview 100 billionaires and share that information on your website. Talk about that. Why the interest in billionaires and why did you purchase billionaires.com?
I'd been negotiating this deal for 12 years and followed up every 3 to 6 months. And they always wanted over $1 million for it. And then during COVID, we got it for under $500,000. I figured that it's probably not bad if I knew a couple extra billionaires. If I get to do business with one extra, it would more than pay for the domain name. I also figured if you're going to watch YouTube videos or listen to a podcast or read a book, why not first read all of the information you can from the winners in the game of capitalism? Otherwise, it's like trying to get good at playing basketball, but a bunch of college basketball players decided to write books and they clutter the market with all their books. But then some people who are only the MVPs from the NBA wrote some books. Why would you not first read the books from the MVPs that played in the NBA, right? I mean, and there's a million business books out there, but who's read every book ever written by a billionaire? Or where can you go to stream insights only from billionaires? And so that's what we're trying to set up at billionaires.com. We've got videos up there on the website from Michael Jordan and Jay-Z, but then we also do exclusive interviews. Like we interviewed Mark Cuban, and we had a billionaire on stage at our last event, and we have 20 of the 100 interviews completed at this point. So if anyone listening is worth $1 billion plus or knows someone who is, we are not doing this to pitch them a bunch of things. We genuinely just want to collect their insights and publish it on billionaires.com. And when we get to 100 interviews, we'll have 300 insights from 100 billionaires. We'll put out a book on the topic. We'll also have all of them public on the website. And the point of doing that is that a lot of these people are very busy and very private. And so we just ask them 3 questions that are non-invasive. We ask them via email. And if the gatekeeper needs to be the person we work through, and we never talk to Michael Jordan himself, perfectly fine. We're honored that he would even take 5 minutes to answer our 3 questions. And then he knows he can't be misquoted because he wrote it himself. and it's been reviewed by his executive assistant or whoever is gatekeeper. And it doesn't take a lot of his time. It's 5 to 10 minutes. And for an A-list billionaire like that, we'll donate $1,000 or a couple $1,000s per minute of their time they take to answer that question. And we'll thank whoever gave us the connection to that lead. But we're excited to get those 100 interviews done. I think if we could put out a really short 100-page book or 200-page book with 300 insights from billionaires, it'd be a valuable resource. And the worst case scenario is that nobody cares about that project. And I learned at least one really cool thing from one of these 100 billionaires, like jokingly, like I don't see how I could lose doing that as a project. So it's just a fun thing we're working on that doesn't make me any money short term, but is fun to do, you know?
What have you learned so far from your conversations or questions that you're providing to billionaires? I mean, what separates billionaires from, say, the centimillionaires that we talked about the last time you were on the show?
One thing I've learned is that they might have momentum. They might be in the right place at the right time, but they also have a really deep work ethic. Like 90% of the time, they work very, very hard. A lot of them were able to find one or two very scalable models on top of having that work ethic and being in the right place at the right time. Several of them, although it's not all of them, probably 20% of them that I've been interviewing or reading books from, really focus on trying to find a niche that they can monopolize or dominate. And then as the tide grows, they're one of the top people in that niche as it scales. I think more importantly, though, than commonalities is identifying what types of billionaires I identify with and fit the DNA of how I work in business. And so for others, this might be completely different of what's most valuable to you. But the best book I've read by a billionaire is from Steve Schwarzman, and it's called What It Takes. And I just finished reading it for the second time. And the way that he developed Blackstone and the way that he started with M&A work to provide consistent fees, but then did LBOs and leveraged buyouts where he could earn a lot of money if the deal went really well, made for a steady business model. But then even more importantly, he found that those two divisions informed each other. So then he would have a commodities division or agriculture division. And by knowing that commodity sales had just gone way down and nobody was shipping commodities today and everybody was yesterday, that informed their LBO on a railroad business. And now they were smarter at the LBO table and smarter at the M&A work because of this commodities division. And so one division informed the other. And the way that he built that out and designed it from the beginning, I can really relate to with my business. So I think it's not so much saying, here's the secret key for everybody, but more so by digesting these types of ideas, it makes you think bigger. And then you might find one where you say, oh, that's really applicable to my niche or how I like to operate or my business model, you know?
That book you just mentioned, and by the way, what was the book and the author again?
Steve Schwarzman, and it's called What It Takes.
Has that been like the template for the way you've put together family offices and all the other businesses that you have, or are there other templates that you've been following as well?
So we started doing this almost on accident by listening to our clients, and we had this multifold business. But then about a decade ago, I heard about Richard Branson having all of his different businesses, and he would find a really powerful leader and partner with them to start a new division. And so that encouraged me to follow down this path further. And then after reading Steve Schwarzman's book, I saw that he did it at even a greater scale than Richard Branson, even though Richard's developed a great brand. And then that kind of reinforces and makes me feel a little bit more confident that we're going in the right direction because it's someone who has taken a multi-pronged investment business very specifically and scaled it up to great scale.
From my perspective, it seems like you've had a lot of great success in all these different areas. Where have you gone wrong? Like where have things not worked out as well for you in the past?
One area is when I went to speak in Liechtenstein, and there was a royal member of the family there, the Liechtenstein family. They bought their own country 900 years ago from Austria. And I went there and I went to their winery the next day. The wine was great. I haven't drank in 11 years, but back then I did still drink. And so I asked them how to buy their wine in the United States. They said they couldn't because their importer stopped helping them. So I said, oh, okay, well, I can help get your wine in the United States. Probably. I'm happy to do a favor to a multi-billion-dollar net worth family that owns their own country. So we had just my secretary fill out a bunch of paperwork and become a federal alcohol importer. And we imported a pallet of their wine. And, we usually have a pretty good success rate with businesses in general. And we just said, oh, let's help them out. Maybe we can do business with the Liechtensteins. And their wine is amazing, by the way. But it turns out like the alcohol business is brutal and I never want to be in it again the rest of my life. And it's really hard. So obviously, if you're listening to this and you own a chain of hotels or you have a big wine distribution business somewhere in the world and you want a connection to the Liechtensteins and their vineyard, I'm still keeping an eye out for them to help them. But that business, we tried to help them in, and it's so regulated and so competitive and so price sensitive. We were like, oh, never again will we do anything in the alcohol business. I think also at one point we started hosting a lot of conferences, and some of them are related to private equity, some real estate. And I thought, oh, well, maybe we should be called Wilson Conferences instead of Family Office Club. And it was a really dumb idea. As soon as we tried to rebrand as that, the interest went down. And then we put it back 2-3 months later to Family Office Club, and the interest went back up. And so I always encourage people to name their brand, name their company, something that draws people in and tells them what you're doing. That's why we just keep it simple, like billionaires.com or investorresidences.com, or for our medical practices, it's just called Medical Clinic Capital. And we just keep it really simple about what we're doing so that it's not confusing. And for the right person that you're trying to work with, it's attractive because they see that you're focused on working with them specifically.
Where do you see other investors who are raising money go wrong?
Having a generic brand, a generic investment structure, not having a video from the founder that's 2 to 4 minutes long telling you about the investment. So I've got example videos of this at, investorresidences.com or dentistinvestors.com. You can see the video of me explaining how we work with dentists as investors or work with short-term rental properties. And it doesn't cost anything to create a video, really. So having a 2 to 4 minute video is super important. A lot of people have a 40-page pitch deck and they don't have a one-pager. And it's really important to have a one-page description of what you're doing, because the really busy investors don't want to read a 40-page pitch deck to decide whether they want to learn more. So it's a big mistake not to have that. And it's also a big mistake not to have a one-liner that's really compelling and really grabs people's attention for whoever you're trying to target. And so an example of a bad one-liner would be saying, we run a nationally recognized short-term rental property company with best-in-class experience, or just something that just means nothing, really. You can't really verify that. Like anybody could wake up tomorrow and make up that same thing. But an example of one that's a little bit more dialed in is saying our 25-person team runs an 83 property short-term rental investment fund where we 2x your capital with no fees. And then what we do, and we have 83 properties in the fund, and that we have a 25-person team. So it just makes it less risky to engage with somebody, because you can't go around saying you have a 25-person team if you really don't, right? Unless you're just a complete fraud, then you can't really say that. But anybody can say you have a best-in-class team or world-class or very experienced. And so the one-liner is critical. The one-pager is critical. The video from the founder is critical. A unique structure, a unique brand. Almost nobody I know raising capital has those things. They're missing half of them or all of them. And those are all things that cost you absolutely nothing. So there's no reason not to have them. I'm not saying you have to go out and spend $500,000 buying billionaires.com, because I started my business 16 years ago with negative money in my bank account, and I didn't have the money to go take advice like that from someone. So I try to 5% of the advice I give people is expensive advice, and everything else is just free to do. So you can profit off of it. And then maybe a year or a decade from now, there'll be some way to work together.
I'm on your mailing list, and a lot of the content you put out is really top notch. So real quick, tell our listeners how they can get on your mailing list to get your insights, and then also find out more about you and your different companies.
Easiest way is to go to familyoffices.com. You can see our upcoming events. You can download our free book on family offices. You can check out charter membership while there in our investor club. But you can also get our free book on capital raising if you go to capitalraising.com. Essentially, we offer 15 live events a year, and the membership is an annual membership, and you get access to all 15 live events and our investor portal with 1,000 investor mandates in there, and a review of your materials a couple times a year. So we can give you feedback on where we would tweak the materials. And our events are made up of one big investor summit every quarter. And Brian, as a podcast host, you're welcome to come to one of our events on us as our guest and get to know us better and get to know our community better as a thank you for having me on here. But we have 4 investor club summits a year that are 500 to 1,400 people each, with 75 to 150 speakers on stage each. And then we have a dozen workshops, and a workshop will be on investor influence and persuasion, or how to structure deals, or how to set up a family office and work with family office investors. and a myriad of other topics related to mostly investor relations and raising capital. So we have an event going on every month, at least one. It makes it easy to attend in multiple parts of the country. So it's not all in Texas or California or Florida or anything like that.
I want to make sure that people want to get on your mailing list to get your insights. How do they do that?
Opting in for the free books at familyoffices.com and capitalraising.com is probably the easiest way, but you can also just reach out to me directly if you have any questions, and either myself or a team member can get back to you. So it's just Richard at familyoffices.com, or you can shoot me a text message at 305-333-1155. And we try to get back to everybody and be responsive as we can be. But email and text message are the easiest, just because I'd rather be spending time with people like Brian on Zoom or just with our family office clients. When it comes to phone calls, it's hard to fit in 50 of those in a day, but I can do 50 emails in a day easily. So
what is your favorite hack or app?
Probably Audible, even though a lot of people use it already. Just the ability, when I'm driving around town, I always have so much going on. If my brain's not busy on a phone call, then it's too tempting to look at my phone and try to answer text messages and Slacks while I'm driving. And I know that's stupid. So by having Audible, my brain can keep occupied and I'm not as tempted to try to work when I'm supposed to be driving. So that's probably one of my favorite things. And then more of an unusual one would be, if you're listening to this and you're making more than $300,000 to $500,000 a year, or you're worth more than $2 to $3 million, and you're not driving the safest car on planet Earth, then you're risking dying from somebody else who's not using Audible and might crash into you, or someone who's drunk. And so I upgraded my cars to a Model X and then a Navigator, and just got the safest cars that I could that are, almost indestructible. And I just, that's kind of a little hack that costs money. But for those of you who already are successful, there's nothing more important than investing in your health and not dying early,
Richard, always a pleasure talking with you. I really enjoy our conversations, and I've enjoyed this one. Thank you so much for sharing your time with us today.
Awesome. Thank you, Brian. Take care.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.